I love passive income, right? That's the thing. It's like I love it. It's part of who I am. What I'm going to talk about today is how do we use this strategy as collateral with the bank, like where you can actually get the bank to lend you preferred dollars. How do you also could use this for major life purposes? Can you use it for business and get a tax write-off? Can you invest to actually buy your turnkey rentals, as we're talking about today, is kind of the main focus. And of course, how can you get your money to pay you not once, but twice in two places at the same time? Just like hundreds of my clients have done over the last few decades, anyways. So we're going to talk about how do we grow your cash faster while you're able to keep it safe. Actually, how you can use a strategy to help you increase your ROI in your real estate, which many people don't know how to do. And especially if you've heard people talk about infinite banking, usually they do it in a way that does not increase your ROI on real estate. But actually, how do you also do this while you keep your cash liquid and still use money to invest, right? Now, I'll take you back to my very first home. This is my starter home that I bought when I was in my mid 20s, right? So proud of this little estate sale that I was able to buy for a whopping 116,000. That crazy enough, this 1,800 square foot 1970s, and by the way, it was vintage 1970s. Everything was from the 1970s. The shag colored carpet plus the green shag carpet that you had almost mow with a lawnmower, um, furry
Love it.
wallpaper, you name it. We had it all, right? But this is my very first home, and this actually started when I was a financial advisor. And this that's what you do when you're a cheap financial advisor. You buy cheap things, right? And so that's what I actually had done. I actually was planning to become a business consultant, but I realized I needed real life business experience before I do so. And so I was looking around for a business to start, and being a financial advisor was kind of intriguing. I thought, worst case scenario, if I learn about investing, this might be worth it. So I actually ended up being a financial advisor. Did that for 4 years. I drank the Kool-Aid. I was telling you to set it and forget it. Save everything, spend nothing, basically be cheap and sacrifice your entire life, and hopefully someday you'll have something. When it came to real estate investing, if people ask me if you should do real estate investing, I said that's way too risky, and you just don't make enough money. It barely keeps up with inflation. S&P 500 is better, right? You never hear that today, do we? Crap. So, anyways, I was teaching all that, and because in my 20s I was young and dumb, and then after 4 years I sat down with my dad. Now, understand, my dad was a penny pinching saver, and as I sat down with him, he's like, "Chris, I'm 61 years old. I want to retire at some point." He's like, "I'm tired of being cheap. I'm tired of saving everything. I want to actually enjoy some life while it's still left," because he didn't believe he'd live past the age of 70. By the way, this week he just turned 81. Speaking of,
Hey, congrats.
yes, congrats or not, right? Depending on how it works. Because here's the thing, he's 61 years old. I look at his finances for the first time. He's 100% debt free, including his mortgage. He paid off his mortgage in 18 years. He saved for decades in his 401k with the company match, like every good boy and good girl should. And despite being a cheap son of a gun and saving everything he could, I said, "Dad, if you want to retire today, you better hope you die in about 5 years, because that's when
Wow.
you're going to run out of money." And he's like, "Okay, that's not what I wanted to hear from you. You're supposed to tell me how to retire." And I said, "I don't know, save more, work longer, maybe into your 70s." And obviously, not the answer he wanted. It was
Mm-mm.
just a few weeks later. I'm talking with a friend that I hired to be a financial advisor on my team, but then he quit and he went to go do this crazy thing called real estate investing. And we start chatting, and I start telling him that stocks are better than real estate. And he finally just says, "Chris, how many of your clients are really financially free where they don't worry about money?" I said, "Well, they all worry about money. Even the ones that are retired still worry about outliving their money." "Okay, Chris, good job." Okay, so nobody's free. Got it. How about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing your mutual fund investments? How many of you guys can actually retire off of these investments? And as I thought about it, I said, "Well, this is like end of 2005." And I said, "I know these guys have been working here since the 1970s, and it doesn't seem like they can retire anytime soon." There's your problem, Chris. And so I started going down this rabbit hole, right? I started going down. I took the Matrix Red Pill, and I started learning about all the different things you could do with real estate. Whether it's rentals or hard money lending or whatever it might be. Like, I learned all these kind of things. And later that next year, not only did I quit being a financial advisor because I could no longer teach something that I knew did not work, but later that next year, I was actually able to retire myself when I was 28, almost 29 years old, having enough passive income coming in where I became work optional. I worked because I want to, not because I had to. And ever since then, I've been teaching people to do that very thing. Now, understand this, though, is that I actually started hearing from these real estate investors about this infinite banking concept, right? Because here's the thing, like, I knew that cash flow is the key, right? Cash flow is what really creates freedom. Cash flow creates more options. When you have more options, then you have freedom. And that's what happened for me too. By the way, I actually had to do it a second time because the recession kicked my butt. So I had to do it again in 2016 just to prove that this works. Okay. So anyways, so what happened is this, is that they started talking to me about this whole, infinite banking concept, this Nelson Nash thing. I said, I've never heard of this before. I was financial advisor for 4 years, never heard of this. They said, it's awesome. Well, I took their word for it. I bought my own policy from an agent, and a few years later, when the recession did hit and my cash flow was getting tight because things were going pretty bad, if you guys remember the recession then, I was in a place where I could not keep paying my premiums and I lost the policy. Paid 25 grand into it and it was gone. 100% waste of money.
Wow.
I thought that's just what it was. It was the recession's fault, yada, yada, right? Well, what I found out is that the insurance agent lied to me. And it got to a point where I ended up talking to him and having this like 2 hour debate. And after a while, he just said, Chris, the reason I did it this way is because I could not afford to cut my commissions. And I found there was actually a better way to do it where you can get a better ROI, less costs. Because it was so costly, that's why I lost it. I found out that I could have actually had it. And in fact, if I had done it the way that I'm about to show you guys today, I would not have lost it even during that global financial crisis. I would have been able to keep it without funding a single dollar into it. And if I had known how I could use it with investing, that would have been even a bigger perk. But I didn't know how to do that either. So that's why I'm doing this now. That's why I'm kind of like preaching from the rooftops, because the truth is that, man, there are a lot of bad actors out there, just like there is in real estate investing, right? Not present company definitely excluded here, but there are a lot of bad people out there, and a lot of bad, not even just bad people, like they're good-hearted people, but again, they're trying to make money, and so they're going to pad their commissions by charging you more than you should be, right? By the way, I'm not the first one to use this kind of concept. You might know who this guy is. He created the happiest place on earth so that now we wait an hour and a half in line for Disneyland. Interesting story. It's actually in his biography. He could not get the banks or anybody to finance Disneyland. Nobody believed an amusement park without alcohol would work back in those days. And so he went around asking for money, even hard money. He finally got an offer from ABC, who was a struggling network at the time. They were an up and coming. They couldn't compete with NBC or CBS. They said, listen, if you can come up with some of the money yourself, Walt, we'll come up with the rest. So he sold off an investment property and he used his life insurance as collateral, not the death benefit, but the cash tax-free savings account he used as collateral. So then they came with the rest money, and now we've got the happiest place on earth, supposedly. You probably know this guy, right? In order for him, when he bought McDonald's from the Kroc, it's not from the Kroc brothers, the McDonald's brothers, Ray Kroc bought it from the McDonald's brothers. He actually paid his executives using his life insurance, right? We got this guy. You might have seen him before, maybe not, but you definitely know his stores. Good old J.C. Penney's, right? Good old Stranger Things reference there. He actually paid his employees during the Great Depression using his life insurance reserves for that very reason, because he was tapped out and banks were not allowing people to get money. They could not, if you remember the whole run on the banks type thing, that was tied up, but not in life insurance. So what is it? It's a whole life insurance. Now, before you start thinking it's like the same old traditional crap that Dave Ramsey hates, and I also hate too, it's not that thing. It's not like what I bought. This is very different, okay? This isn't traditional whole life. This is something that we're doing that's very, very different here. We actually refer to this as a freedom fund, right? This is something we actually use. It's something that's very liquid. You're able to actually use it. We even trademarked Max ROI Infinite Banking just to distinguish from the rest, because again, people talk about this concept, but they're not all created equal. In so many cases, you will pay more in fees than you need to, which sucks out the cash that you need to grow and invest and even just have as cash reserves. By the way, if you ever just want to get like a free look, here's the little barcode, or whatever you call it. Barcode. That makes me sound so old. It's a QR code. You can actually use this to scan even just to book a free call. You can find a barcode too somewhere, I'm sure. But here's a QR code you can actually scan if you want to just say, hey, I've actually heard about this already. I would love to know how to do this. I'll bring this up later as well. But this is actually the QR code you can use to book a call for free. That's on us. So again, we found a better way. I've really perfected over the last several years. So let's talk about what makes this different, right? What's interesting about this is that traditional infinite banking, or even not even infinite banking, this is just traditional whole life. This is what everybody poo-poos on, right? This is why people hate it, because it's super duper expensive. Understand that term insurance, many people have bought that. Term insurance gets more expensive over time. But whole life is the opposite. It's front loaded with its fees. It gets cheaper over time. So they front load those fees, and there it goes. On the left here, what's interesting is there's another insurance agent out of Florida that said, "Hey, Chris, I know you work with this particular insurance company. Can you take a look at it and see if there's a way to do it better?" This woman, this is a doctor, she was committed with this other insurance agent, not him, but another insurance agent, this financial advisor that again are just salesmen in suits like I used to be. Um, Set it up, her putting in $60,000 a year. Now, there is a death benefit. That's what's on the right-hand side there. You see their total death benefits like 5 million. But that highlighted in yellow, that total cash value, notice it's $0. So year one, she already paid her 60,000, which is why it shows she paid zero, but she already paid her 60. Zero cash value. That means all of it went to paying for the death benefit in year one. Year two, she puts in another 60,000. So now she's paid in 120,000. All of it goes to pay for the insurance costs, which, by the way, just so you know, pays the insurance agent commissions. They get paid a percentage of those costs. Year three, she puts in that third set of 60,000. Right now it's 180,000 she's put in. She finally has 30,000 bucks in there. This is why whole life insurance gets a bad rap. This is why Dave Ramsey hates on it so much, because it sucks. It really does. This is what I bought and as a result lost during the recession because it's so costly up front. Now, granted, after you get past those first, 4 or 5 years, now it starts to work better. But notice, it wasn't until year 13 right there when you have about 800,000 that you finally have more in cash than what you paid in. So it took 13 years to finally say, yay, I got to 0%. I basically have free insurance at this point, is what it took. The right-hand side is what I sent that other insurance agent. I said, here's what you can actually do with the same exact company. Because it's not about the insurance company so much as it is about how the agent designs it. Same thing, look at the difference here. Year one, $50,000 in cash, not zero, 50,000. Even year two, there's now, if you go below, 106,000. So where there was zero, we already have 106,000. That means we've already saved them over $100,000 of costs and fees. By year three, it's not 30,000 bucks, it's 168,000. Crazy, huh? Year five, just so you know, you have $8,000 more in her case than what she paid into it by year five already. So really by year three, it's paying for itself. Year five, you have more than what you paid into it, and the thing just keeps going and going. So even though, yes, it still has a death benefit, not as big because we're not focusing on as big of a death benefit, but still way, way more cash. And as you can even see later on, like, although I highlighted the wrong one there, but still year 25, $3 million versus their 2.3 million. So there's 700,000 more in cash even after those 25 years. Same company, just designed differently. This is why insurance has a bad rap, but this is also the potential because even that year one, $50,000, guess what? You can access it. You don't have to wait 3 years to get to it, to get to a little bit of money. You can actually get to that cash day one. This is very, very important to understand, especially in how we talk about using this as an investor, especially. So, yeah, we got a QR code if you ever want to watch an example. This is actually, you guys actually might know these guys because they were dentists that were in a group that in a mastermind were together. We actually saved this dentist. I actually wasn't going to do anything with the policies they already had, but they want us to look at their own policies. And so I said, all right, I'll take a look, but we probably won't change anything because you've had it for 6, 7 years. I ran an apples to apples comparison between what the policies they had, even after they already went through those expensive first years, compared to what we would do starting over. And after 20 years alone, they would have $2.25 million more with what we were doing in our policies. $2.25 million more. And they would still have a bigger death benefit. So massive difference. So that's kind of the QR code if you ever want to watch their podcast interview on that one. But that one shocked me. And then I have other examples too. This is the other thing too. Another thing about whole life you got to be careful of is that often whatever they set as the premium, that's what you have to pay, right? Just like what I had to pay. I was paying $1,000 a month, 12,000 a year. I couldn't pay any less. In this guy's example, even though this guy was in, kind of bad health and he was in his mid 50s, still he only has to pay 6,000 a year, even though he can contribute up to 20,000 a year. So there's a lot of flexibility you can build into these things too. Here's the secret. Here's how I would fund this in a way that works best, because the number one objection I actually like and I agree with, everybody will say is, yeah, but Chris, if I pay money into this, well, now I have less money to invest. Even in your example, Chris, If I put 60,000 a year, 10,000 goes to cost. Now I have 10,000 less to invest. And you're absolutely right. That's why I don't recommend doing that. Your investment money, don't use it at all in those early years. In those first few years, just build up your emergency fund by moving your money from an emergency fund in a crappy point nothing percent savings account in your bank, move it over to this, just like you're transferring to a high yield savings account. Because by the way, it is high yield. Right now, they're paying about 6% a year tax free. So right now, my best high yield savings account is paying just over 3.5%, and I get taxed on that 3.5%. My credit union is paying me a whopping 0.05% and then taxing me on that, which means I walk away with basically no interest. Here, I can make tax-free interest, and it's 100% protected from lawsuits and creditors. So what I would do first and foremost, those first few years, just use your emergency fund to move money over. Even if it's like, say you have $100,000 in your emergency fund today, maybe you only do 30,000 a year or something into this. That's again not the required premium. That's just the max they'll let you contribute if you set it up that way. Move that money over the next 3 years. You'll have almost that much back anyways at the end. But now you have all the money you're going to invest anyways. Invest it. Don't do what a lot of those infinite bankers say, which is dump in all your cash in year one, which is where they get paid the most commissions. Don't do that. Instead, take your cash and split it up, but use your emergency fund and then use all of your money to invest right now. That's the key. So then you can get your passive income going right away, which by the way, guess what? Your passive income that you're earning can then also help to then contribute more into this to then build it and grow it tax-free and then use that money again to invest later on, especially after years 3 or 4 and beyond, right? So that's the key is use your emergency fund first. After a few years, and as it really starts to build some cash, then you can start using that to make money in 2 places at once. And even just to compare, the one thing that's different is that, like I said, like 3% the guarantee, but right now they're paying 6% a year. Historically, that's actually low because of the low interest rate environment we've been in. High yield savings accounts, you're likely to get 4 or 5%, you're going to get taxed on it. Where 401ks, here's the thing with the 401k. Yeah, you might be able to make more returns possibly in the market. Maybe, maybe not. But what's the problem with a 401k? It's locked up. It's in prison, right? You can't get to it. So why not have something where you can actually access the money right away and not worry about 10% penalties if you're not 59 and a half and other fees and things like that. Plus 401k performances are crap, by the way. Just so you know, Fidelity, their mutual funds, their performance is so bad on their mutual funds that your match only makes up for the bad performance. You could actually make more money investing on your own than getting a 100% match with your employer on a 401k. That's a fact. For the last 10 years, that's been a fact. And that's with the best market we've had in a long time. So anyways, quick access to funds, asset protection. By the way, this is another thing too. Not only are you getting 6% tax-free right now, but also it's 100% protected from lawsuits and creditors. Where if you have your money in a savings account, if somebody sues you and wins, they can liquidate all of it. They can get to it. 401k is protected, but you can't even get to it, right? Especially if it's a company 401k, you got to leave it there and it sucks. Here, the money is protected from lawsuits and creditors, unlimited in most states. There are a few states that have some limitations like California, but most states you can have millions stored in here and they cannot get to it. Like I mentioned, it grows tax-free, comes out tax-free just like a Roth, but you don't have the 59.5 rule. You don't have any of those rules at all. Contributions, you can contribute up to 25% of your stated gross income, not tax return income, stated gross income. I had a real estate investor. He was a syndicator. He said, "Hey, Chris, my tax return says I only make $25,000 a year because of all the write-offs I get through real estate as a real estate professional." He's like, "Can I put more into it? What can I do?" I said, "Well, you're a real estate investor. What do you actually make gross after, when you get everything coming in, not even taking out, all the write-offs and stuff? What do you bring in every year?" He's like, "About $1 million a year." I said, "You can actually contribute $250,000 a year into this. Where in a 401k, you're going to get, you're going to hit that limit around 23,000, or if you have the matches, it's in the 30s. Here, it's 25%, pretty much almost unlimited." So he started putting in $250,000 a year. By the way, he just did another one where he added another 60,000. So he's putting in over 300,000 a year into these plans that, again, 100% protected from taxes, creditors, and lawsuits, right? And there's no market risk. You don't have to worry about stock markets and all that kind of stuff. And here's the cool thing too. If the government ever changes the rules like they do on 401ks and IRAs, that does not happen with life insurance. Whatever the rules are at the time you buy it, that contract, they stay that way. So even if the government says, "You know what, we changed our mind. After more than 100 years, we're going to get rid of the tax-free status on life insurance," you're still safe. Your money's still protected because you're contractually bought in at that time. So that's one thing I like as well. I don't trust the government. I know that they'll change their mind a lot depending on who's in office. So I like to have more control of my money. So, but again, you could do a lot more. People say like, well, how do you do the whole, like, how do you make money twice, right? Here's what you do. Here's a strategy you can use when you're using it with cash flowing investments like real estate. Most people just take money, they put it into their investments, they get cash flow, and then the cash flow goes back to their savings account. But instead of putting it into your point nothing percent bank savings account, do this instead. Use your life insurance policy in that place. Because you have one of two options. You can withdraw money from a policy, but here's the problem. When you withdraw money from a savings account or anything, what happens? The money is going out to buy that investment, but now you're no longer earning interest on that savings account. Wouldn't it be cool if you could say, how can I access my savings account and still invest with it, but then not pull the money out? So what if I could still make all that money in the savings account? Say I have 100,000 in there, it's still paying me interest, and I can still use 100,000 to buy a property and put a down payment on a property. Could I still make money in two places at once? Typically, no. Although you could do it with a savings account by doing this. Get a collateralized line of credit. If you have a savings account right now, you can go to your banker and say, can I get a collateralized line of credit against my savings account? And they'll say, well, of course, because we're going to lock up your savings account. We'll let you give you a line of credit you can pull out from our money. So you're not touching your your 100,000 that's sitting in that savings account. You can go and access the money from the bank. Now the bank will make you pay it back, right? When you're just using a savings account, banks will set the monthly payments. They also pay you crap on the money that's sitting in that savings account anyways, and they'll charge you a lot more. Insurance companies can do the same thing. You can borrow from the insurance company from their money, leaving your money still there, earning tax-free compounding interest. Like I said, right now it's 6% a year or more, depending on the company. So you're still getting paid on that money, but then you can get this line of credit from them and use their money to invest. So as you're compounding your income, now, yes, when you do earn cash flow, the key is this: take the cash flow and use it to pay back towards the line of credit. Just like if you got a home equity line of credit, many people will do this strategy. They'll get a home equity line of credit, invest with it, and then they take the cash flow from that investment, those properties, and use it to pay back towards the line of credit. Same exact strategy, but the cool thing is this: when you get an insurance line of credit, you can pay it back however, whenever you want. There's no minimum monthly payment. It's a private loan. You don't have to have good credit to do it. It's purely a collateralized loan that they trust because they know they're going to pay you pretty much about the same that they charge you in interest, right? But what's happening too is that you can pay it back at worst at your death. So at that point,
Chris, I think that's an important one to repeat because that's a pretty big benefit that is unknown or definitely overlooked.
Oh, absolutely. I didn't know about it, right? And I was a financial advisor and I never knew you could do that. So remember, this money, because it is secure, because they know they're paying you interest anyways, they let you access that money. And again, you're not required to make a monthly payment. So, man, I'll tell you, real estate flippers love it because if they need to renovate a property, they don't have to keep paying on the money that they borrowed. They just want to be able, they are being charged interest in this case, but they're also being paid interest at the same time. So it kind of washes it out. And in fact, if you do it right, if you use the cash flow from your investments to pay it back, what happens is that you pay less in interest to the insurance company than you earn that they're paying you. So you make more here and you're still making the cash flow from your property. And again, you don't have to pay back that loan. I do recommend you do that this way because it does improve the numbers and how you double dip in two places at once. But like I said, worst case scenario, the loan gets paid back when you die. So say that you had $500,000 worth of loans outstanding, right? But you had a $2 million death benefit. What they'll do is when you pass away, they take their $500,000 back and then pay the other $1.5 million to your heirs tax-free. Because again, the death benefit's also tax-free. So that's what they would do in that case. This is why sometimes I joke with people, you can literally spend down your kid's inheritance, right? Like instead of leaving it, you could literally spend down the life insurance, the cash and everything that's in there, which also lowers the death benefit too, right? So you could do that, or you can leave more behind. Again, that's a whole nother conversation. But the key strategy is this: if you want to make it work and sing, using the cash flow from the property to pay back towards that line of credit, which then builds up the cash available to pull out one more time to then do it again. And it just keeps cycling the money. Cash flow comes in just like you would do if you put it in the savings account, but now you're just paying it down and allow yourself to earn money in two places at once. Here's what it looks like, right? Say you buy a quad, say it's $1 million quad. I'm sure you probably have fourplexes that are right around there, give or take. $250,000 down payment. Now, I know this is a cash rich example. 2,500 a month is not necessarily realistic, especially with new builds, but I was keeping the numbers simple and I'd already spent hours doing the math to make sure it worked. But let's just say that you're making 2,500 a month on that, right? Net profit. Now, if you use the savings account, you'll drain your savings account for that quarter million and took your 2,500 a month or 30,000 a year. After 9 years and you pay your taxes on a 0.1% bank savings account, you will make in 9 years $1,200 of interest. That's it. Yeah. I'm sure nobody gets excited about that. Well, what if we did the same strategy using life insurance? And I use my own policy. I'm in my mid 40s, going into my late 40s. But with my own policy, I use my own numbers. I said, what if I were to do the same thing using my policy, which is set up just like everybody else's? What would that look like? Even after I pay the insurance costs, right? Because there are insurance costs still coming out of my policy. And of course, even the interest cost that I'm paying the insurance company, I'm just cycling that money through, but using the cash flow to pay down that line of credit. What's my net interest return that I earn on that money? About 100 times more, 126,000 profit. And guess what you can do with that 126,000? You can do it again and buy more properties, right? And accelerate the passive income. This is critical. This is key to understand.
Yeah, that's great.
So as I love my favorite SNL sketch with Will Ferrell in it, talking about how you need more cowbell. Well, I got a fever. We need more arbitrage, and that's what we're doing, right? We're creating more leverage with our money. So now let me just say this is who it's not for, because I know we're wrapping up right now. Two classes of people that this will not work for. One, if you are paycheck to paycheck, don't do this strategy. If you're literally like you have no extra money, I would just buy a simple term insurance policy that you can convert to this down the road, right? And that's something that we also help people do too. If you can save at least $5,000 to $10,000 a year, not required, but at least if you can save up to that much, give or take, that would probably be preferable. Then I would say this strategy could definitely work. And yes, I get people asking, can I do this with my kids? Could I use this instead of a 529 plan? Yes. And guess what? You don't have to worry about whether they go to college or not. And then say, oh, what do I do with this money that I just wasted because they didn't go to college, or they got a full ride, or they're an entrepreneur now. Now I can't access this money without penalties. Many of our clients are now dumping their 529 college savings plans to do this instead for their kids. So yeah, you could do it for them. Also, if you're in bad health, or maybe you're into your 70s or 80s, probably not the strategy we would use. Bad health, obviously, it might be that you get denied insurance or just be super expensive. There was one dentist that we were working with that he said, listen, Chris, I'm in my mid 50s and you can see I'm overweight, very overweight. I'm sure this is going to be expensive even if I get approved. Could I do this on my wife instead? I said, yeah, absolutely. Is your wife healthy? He's like, yeah, she's healthy and she's 3 years younger. I'm like, even better, because women live longer. So if she's younger and women live longer, they get better rates anyways. And she's healthy. Let's do that. And so he started putting in $110,000 a year into his wife's policy. By the way, this guy got sued, and this is the only place he has his money where it's safe. So he actually did get sued and was able to prove that. So again, if you're in bad health, older than 70, 75 or so, this may not be a great strategy, but yes, you could do it on somebody else. Anybody that's like children, could be business partners or key employees. Anybody you have a financial self-interest in, you can also get a policy on as well. So that's a workaround there. So I'll just end with this. Remember that the most dangerous risk of all, as this says here, the risk of spending your life not doing what you want on the bet that you can buy yourself the freedom to do it later. We don't know how much time we have. We don't know. I mean, I had a client that just passed away a few months ago, man, and he had actually bought a few duplexes, and he got into some like oil and gas stuff. He even got some apartment syndication and whatnot. Was able to get him to the point where he had his $1 million turning into about $130,000 a year, right, of passive income. He just passed away after 4 years of having that freedom. He just passed away. The thing that I love is that he was able to live that life now. And as my sign says back here, live your life now, not tomorrow. Speed is everything, right? Not just the insurance side, but the fact that what you're doing right here with Southern Impression, right? What you guys are doing with them, like speed is essential, right? Because time is the only thing that's on your side. But if you don't take advantage of that time, that's the one thing that'll be your worst enemy too. So be sure you take advantage of how you do what you really want to do here, right? So by the way, that's kind of the then and now. My dad, like I said, just celebrated his 81st birthday. This actually a picture we took with him as well. But this is the thing, guys, like he's alive, but he's not really able to live, if that makes sense, right? He's now bedridden. He hasn't been able to enjoy it. You can start doing that now, but it's up to you. So obviously it's the big things, take action. Again, if you want to see how this works in your situation, what does that look like? Here's a QR code. You can use that. So I'm done at this point. Any questions from the two of you or anybody else?
Well, I know I have a starting question. I'm sure there'll be more coming in to Jennifer, but people always look at something, Chris, like this, and they put up kind of a false wall or defense and say, wow, this is going to be too hard to set up. So I think it's always good to say, what are the actual steps that people go through to do this?
Yeah, it's pretty simple. I mean, we make it easy because again, we do it differently. We come from more from investor business owner perspective, right? Most insurance agent you talk to them will say, how much life insurance do you want? What's the death benefit you want? Although we can consider that, we really don't give a crap. We focus more on what's the max amount you want to contribute. So the first two questions we ask somebody is, one, how much do you want to be able to contribute each year? And then two, for how long do you want that option? Because here's the key thing to understand with our kind of policy is that you can always pay less than what you have planned, but you can never pay more. So for example, like that comparison of the $60,000 a year, that's the max that that person would be able to contribute. If you try to put in 60,002 cents, you trigger taxes on any gains in that policy. So if you want to keep it tax free, you don't want to go over that amount. So we just figure out from people like, hey, how much do you want to do? And usually people say, well, okay, I'm saving, let's say, 2,000 a month or 25,000 a year. Great. Well, then we might set the max contribution limit maybe around 18 or 20,000 a year. But here's the cool thing: you're not required to pay in 18 or 20,000 a year. Depending on your age and your health, it might be anywhere from a quarter to a fifth of that. So let's just say it's 20,000 a year max you want to do. Your minimum required premium is only about 4 or 5,000 a year. That's
Oh,
it.
that's good. So, but with term though, if the term is say 25 years when you get it, you're
Yeah.
not going to get any of that money, and you literally would have to die to get the money from the
Yeah, you don't get any of it.
correct. Your family
Yeah.
would. You can't use it.
It's literally death insurance, isn't it? Where this is talking about how to use this while you're alive. It's life insurance. I like what if you guys have ever heard the guy Tom Wheelwright. If you've ever read some of the Rich Dad books, he's the CPA that's part of that. He'll say this. He'll say term insurance is an expense. Whole life insurance is an asset, right? Because it is. Because here's how I use it myself personally. I'm not leveraging it all the time to buy real estate properties, even though I could. But I'm not as often because I've actually been building up my cash reserves, because what if the economy does blow up? I wanted to have a little bit more cash. And so, like, my wife, we discussed it. We're like, well, how much do we want? We're like, maybe $400,000 is what we want to keep liquid. Well, I don't want to keep it in my bank account earning 0.05% that I get taxed on because I'll make a whopping $200 a year that I have to pay taxes on, right? But instead, what if I earmark 300,000 to be in just my life insurance that I don't invest? That's just the minimum balance I keep in there. That 300,000 is paying me 6%. That's 18,000 a year, not $200 a year, 18,000. The other 100,000 I'll keep between bank or high yield savings accounts because I can get to those quickly. Just so you know, it takes about a week or so to get money from your policy. So you can get to it at any time, but it might take about a week or so to process and transfer to your bank account electronically. So that's why I'll keep the lion's share of my cash savings here that I won't touch. But then I'll use all my other cash, especially my crappy bank savings accounts. I'll liquidate that all day long to invest in deals. Where my life insurance I'll use as emergency fund / opportunity fund. If like, oh, okay, I can't pass up on this deal. I've already liquidated the other assets, the other banks, my other investment savings or whatnot. This is when I'll start tapping into it and using and leveraging it that way.
Any questions in the chat right now, Jen? I'm not sure. No, you're muted too, Jen. Still muted.
Sorry. I was gonna say I don't see any questions in here yet, but I see that the link to for any questions from Money Ripples. But is there a way to get the QR code from the Jorgensens to see that in here somewhere? Or a link to it?
I don't have the direct link. If
Okay.
you, but if you do,
we'll send it out with the recording. How about that?
Okay.
If you get that
Let's
to
do
our
that.
team, Chris, we'll send it out with the recording.
Okay, that would be great. Okay. Yeah, because that'd be something good for people to see that and see how it actually worked from, real people.
Yeah. And I'll say something about that too. If you do have a current policy and you want to have it reviewed, we can definitely do that. You can call up the company, ask for what's called an in-force illustration, and then we can kind of see if it makes sense to do something. I had somebody send one to me last week, and I said, honestly, at this point, even though it's Northwestern Mutual and they all suck, I was like, that one at this point, you've had it for 11 years. It's probably not worth changing at this point. But for them, we did that same thing and did the same apples to apples and was like, oh my goodness, no, we need to change it. So that's the thing. We'll give you an honest opinion. If it's good, we'll tell you.
Do you require a certain amount of money? Say that if you've got the life insurance or an IRA or any way you want to move money and do like a policy, is there a minimum on that?
Yeah, I just say that, usually it makes sense if it's at least 5,000 a year you can contribute. I'd say that, but no, it doesn't have to be a lot by any way, shape, or form. I have some people that pay hundreds of thousands a year, and others that pay just thousands. It's really flexible. One question I do get sometimes, people will ask, they'll say, well, what if I do get to the point where cash flow improves and I'm already maxed out? What do I do? Like, well, you can set up another policy on you, a spouse. I recommend you and the spouse first and foremost before you're worrying about the kids. Like you can do it on your kids, you can do all kinds of things. And so that's the nice thing is that even if you max out that one policy, great. If you have more cash flow, do another one. I know we have a mutual friend. He does real estate, lives out in South Carolina. And, he was actually lamenting a little bit in a mastermind that we're a part of. He's like, you know what? I'm so tired of Chase Bank ripping me off. They don't even treat me well. And I have millions stashed with them. What do I do with my money? And I reminded him, I said, hey, remember, you've got one of these policies already. Just set up another one. And so he did. He's like, okay, I'm already doing 50,000 a year in this one. I'm going to do 100,000 a year now into this other one and get my money away from the bank. I call it unbanking yourself, right? It's just get it away from the bank. And especially if there's a bad recession, who's always the ones that suffer first? It's always the banks, right? They're always the ones that have the big issues. So that's
Okay,
why
I do got two questions here. So one says, this is from Rob. He says, can you please repeat the dual use of cash value with an investment scenario?
Yeah. So just like that one that we had there with that 2,500 a month, right? Here's what's happening. This is the thing that's confusing because most people think, well, wait, I'm borrowing my own money. Why would I borrow my own money? You're not. You're borrowing the insurance company's money. Your cash is just used as collateral, right? And because the cash is safe, they know they'll give you up to about 95% of whatever you have in there. So like in that example, the 250,000, your 250,000 still sitting in there being paid tax-free interest, right? You're still compounding interest in there that they're paying you each and every year. But you're borrowing money from them. And again, you could withdraw money. That is an option. You don't have to borrow every time. I did tell that to one guy the other day. But no, you can actually borrow the money from the insurance company and use that money to invest while your money is just being used as collateral. Now, they will lock up that money, right? Because obviously they don't want you tapping in more money than you have. But as you take that cash flow from the investment, pay down that line of credit, as it pays it down, you start to pay down the loan balance. That frees up more cash that then they'll say, great, if you want to tap into it, you can use it again. Think of it almost like this unlimited line of credit that's always just there. You can use it whenever you want, right? So that's the key, is that they're paying you interest, and yes, they'll charge you interest, but as you pay down their loan, you're paying back with simple interest while they're paying you compounding interest, which is not the same. And it's a whole math thing that I've shown in other videos on my Money Ripples, YouTube channel and stuff. But needless to say, that's how my example shows you making $100,000+ in interest, net interest above and beyond, is because you get charged less and less in interest over time as you pay it back, with the cash flow, while they're paying you more and more compounding interest over time too. So it's kind of that inverted curve that happens when you do it that way.
Yeah.
Okay, I've got from Wayne. He wants to know, can a person do a one-time lump sum payment up front without, and then I don't know if this is misspelled, it says MECING, capital
Mecking.
M-E,
Yeah,
mecking. Okay, I didn't know what that.
triggering taxes is what he's
Oh,
asking.
without triggering taxes. Okay.
Yeah. So you can, yes, but I'll tell you this. I generally don't recommend it, even though there are plenty of insurance guys that would love you to do that because they'll make huge amounts of commissions if you throw in a big lump sum up front. I don't recommend that because, one, that's mainly it. They will charge you a lot of fees to do that. You would be better off splitting it up. Now, I'll teach you a strategy I just barely shared on my podcast like this week that you could do if you're thinking about, you're like, I've got this money earmarked, I don't need it. I had a guy that was a rancher recently that came to me. He said, "Hey, I've got some cash. I want it just for my family, and I want to make a good use of it. I don't want to invest it. This is just for my family." It's like a couple $100,000. He's like, what can I do? I said, here's what you can do. Instead of trying to throw it all in at once and you get charged massive fees, let's break it up. But let's do it this way. And there's a particular insurance company that they have their own, almost like a CD that pays 5.5% right now. So I said, here's what you're gonna do. Take that 200,000, throw it in. They'll pull out the first year's premium, and we end up doing the math. We broke it up over 5 years. It's like 44,000 a year. Well, you're probably doing the math. You're like, wait, 200,000 divided by 5 is not 44,500 bucks a year. No, it's not. It's 40,000 a year. But if you take that 200,000, they're pulling that money out, the 44,000. Now you've got like this 156,000 in there, right? That's now earning 5.5% interest. So they're paying you interest in this little kind of CD thing. And then each year they just draw it out and pay your premium for you for the next 5 years in this case, right? And so what happens is that he'll end up making like over 20,000 more of extra interest in the meantime. And it goes into his policy and he ends up having way more. So he ends up making like $30,000 of interest over those 5 years. And all that money's still liquid and available if he wants to use it, but he's making a lot more money on that money. So there's ways that if you want to say, well, if I just want to put it in and not have to think about a premium, cool, we do that. Take that lump sum, throw it in there, earn some interest, but just let that pay the premium. So then you have less costs coming out and you end up making more money as a result.
Okay. Wayne also wants to know, can a person open a policy on a grandkid?
Yeah, you can. Yeah. They want to make sure that parents are insured first, but yeah, you can have a generational type of thing. Yeah.
Good to know. And
I was
then,
going to share a story, but I wasn't going
okay,
to share a story. So
go ahead and share it. Then I'll ask them.
no, it's fine. No, yes, you can set it up on grandkids as well, but they'll want to make sure that the grandkids get evenly treated.
Oh, I hear you. Got that. Okay. Also, if cash becomes worthless, does this impact the IBC account? Is it in danger?
Well, you are using US dollars. If the dollar ever becomes worthless, which I, by the way, don't think will happen anytime in the near future, that would take a lot of world shakeup to even make that happen. But yeah, here's the thing. What affects the dividends that you get paid are the treasury rates, right? So if we move to a recession, right? Like remember 2020, we went down to like 0% interest rates. That 6% account was paying back then about 5.75, right? Now, if we had stayed at 0% interest rates, it's very possible it would have stayed somewhere in the low to mid 5% range, but it still paid very nicely, even though we were at nothing rates. And even I remember my high yield savings account was paying like less than 1% at the time, right? It was still paying over 5%. Now, today, rates are higher. We're seeing those dividends go up again. By the way, in the 1990s, they were paying double-digit returns. So it's always based on what's going on with the treasury rates. If they go up, you make more money. If inflation is going up, that's a good thing for you because they'll start jacking up their rates because the treasury rates usually go up in response, right? If things crash, well, yeah, then of course those rates can go down. Remember, you're still guaranteed to get at least 3%. And I'll say this too. Here, if worst case scenarios, right? One of the companies we use most of the time because they're the most flexible with fees, they've been paying more than their minimum, more than that guaranteed rate since the year 1847. That's pre-Civil War. All right. Even during the Great Depression, we saw 2/3 of banks fail while only a handful of insurance companies failed. Right now, insurance companies also buy what's called reinsurance. So there's global insurance companies that actually back up or financial backing behind insurance companies if in the rare case they ever do fail. The reason they don't fail as much as banks is banks will over leverage. Insurance companies cannot do that. They cannot over leverage that way. They're not a bank. They can't do that fractional reserve banking or anything. So as a result, the rare case that they do go under, the reinsurance companies step in and make sure that your cash and your death benefit are all protected until either another company buys it up or they just keep it until you die. So the great thing is I tell people this is literally safer than a bank. Because FDIC, do you really think FDIC has a lot of reserves? They've got 1.5% of the total bank savings reserves in their reserves. You remember how hard it was in 2020 to get the EIDL and PPP loans and all that stuff? There's like, hey, we're going to give you money. And they're like, where is it? Oh, it's coming. It's because they had to literally print money out of thin air, right? That's not the case, like we don't have to worry about that kind of stuff, So yeah, worst case scenarios. In the rare case that the company will fail, a reinsurance company will step in and back up your money. So I think it's safer than keeping it in the bank.
Okay, got one more from Wayne. He says, do the IBC insurance companies use any precious metals to diversify their investments? And also, other than treasury rates, what do the insurance companies invest in to provide dividends and interest?
Wayne, you're going deep here. You're gonna like run us over time, but no, those are great questions.
He's got good
I'll answer.
questions.
Yeah, I'll answer quickly. Yes, companies, depending on the company, everybody has their own different things. Like some of the companies we've used, some of these mutual insurance companies, like you mentioned, they will invest a little bit in alternative investments. It could be private equity, can be gold and silver and things like that. Real estate of various sorts they've done as well. So yeah, there are alternative investment assets in their portfolio. But with mutual company, here's the difference. There's stock companies like your MetLife, right? Stock companies will pay their dividends to your stock shareholders. A mutual company is kind of like a credit union where they will pay you a little bit more interest because they pay back to the members. Mutual insurance companies pay back to the policy owners. So the funny thing is that term insurance, over 99% of term insurance policies never pay out, as Jen, you had just mentioned earlier, right? Well, all those profits from that, for a mutual company, the profits of an insurance company gets paid to the whole life insurance policy owners. So you make money one of three ways. One, they always guarantee like a return of premium. That's that 3% guarantee. They always pad in a little extra in case there's like big world events, things that happen where more people die than expected. If that happens, by the way, COVID didn't affect it at all, just so you're aware of that. But yeah, like if there's anything like that, they always pad in that 3% guarantee as the cost they're going to return back to you anyways, especially if things are just normal. Two, they will do their portfolio, their investment portfolio. And then three, any profits, if it's a mutual company, any profits that they make as a company gets paid back to you as a policy owner. So that's how they make their money.
All
Very
right,
good.
great. That's it. I don't.
Listen, yeah, I mean that is a wealth of knowledge, and what I would encourage that I've had probably conversations with people on here. I know with the two of you, starting is the biggest requirement. You know, everyone wants to have passive income in real estate, but they don't want to get the start going and start to see the lag kick in. And same thing with whole life. There is a starting mechanism to it, but it does have a nurturing effect, you know, just like planting the seed. I've seen it with real estate, with whole life, and these two can work really well together. And so again, I encourage you, take advantage of speaking to Chris, take advantage of speaking to Jennifer, Allison, you know, how these things marry each other and how they can work together to produce what Chris is talking about. Unfortunately, my dad and Chris's dad have very similar stories. I don't want myself or my children to be in that situation. And so there is a big driving force here. So, you know, take advantage. Chris, I do want you to remind them one more time, is the best way to reach you just the QR code, or do you want to give an email as well, or a website? How would you? I just want to make sure people can reach you.
Yeah, if you
There's
just use
a
a QR
link.
code.
There's a
There
link
is a
also.
link.
Jaden put a
Okay.
link.
Great.
Yeah,
So
the link,
in the
yeah,
show.
whether either one you use will take you right to a calendar booking site. So you can just book a call right there, make it really easy. And again, no commitment, no, we're not making you pay for it or anything. And just so you know, even starting these policies, if you're in good health, it could be as quickly approved as soon as like 24 to 48 hours. It's pretty crazy.
So good. Well, listen, Chris,
Okay,
thank you
real
for
quick, Jaden, will you make sure that whenever we send out the link to the recording, or so that we have Chris's phone number and web address so that people can contact him?
Absolutely.
Okay.
All right, great. Well, listen, thank you for joining us again tonight, Chris. You know, congratulations on 1,000 episodes on Money Ripples. I know it's a very popular podcast. It was an honor going on it, and we appreciate your friendship. We appreciate you being an investor with Southern Impression Homes and what you're bringing to the rest of the community. So with that, I appreciate everyone for joining us tonight, and we'll look forward to our next conversation.
Thank you.
Take care, everybody.
All right, bye.